All right, Mortgage Guru fans, welcome back. This is John Kutzmita, your Mortgage Guru. And here we are, the first episode of 2023. Let's just jump right into it because you would think maybe going into a new year, it's the first week, things are a little slow. Nope, not this week, not 2023. We got right into the mix this week, although, okay, in the beginning it was a little slow. But by Thursday and then today, Friday, wrapping up the week, there was plenty of fireworks, plenty of New Year's fireworks. So let's look at it. We had on Thursday an employment report that comes out from ADP. Now, it's not as heavily tracked, but it's kind of like the smoke before the fire, which is the Friday NFP report, non-farm payroll report. And they don't always follow one day after each other, but when that ADP report comes out, it does tend to come out before the non-farm payroll and give a little bit of a hint as to potentially what that non-farm payroll survey is going to look like. And we're going to talk about why the heck NFP, why non-farm payroll, what is it? But the ADP report suggested that employment was continually strengthening, that more jobs are being added. We're already at what one would consider full employment, record employment, although there is still what is considered a tight labor market where there are more jobs than there are people seeking employment, which should be a good thing. But that can also contribute to growing or increasing wages, which tends to be inflationary. And we've had more than our fair share of inflation the past 12 months or so, record high inflation, or at least the highest inflation in 40 years. So the last thing we want is more inflation, especially unless, and wages are keeping up. And although a little bit of an increase in wages could be reflections of ongoing inflation, it doesn't necessarily mean that it's keeping up with inflation. So we want to see those inflation numbers come down, at least the Fed does. And certainly we do in the mortgage world and the real estate world, because high inflation means high bond prices and low bond prices and high interest rates. This goes for both U.S. government bonds and, of course, mortgage bonds, which drive interest rates, which we're going to talk about today as well. So back to non-farm payroll. So this is a survey. I'm not a fan of this. I don't, in today's market and with technology and all kinds of other different methodologies for communicating and having reach with the world, with the community, with the country, why we're still doing these goofy surveys is beyond me. And there's different components to it. There's also what's called the household component, which, look, there's a lot of doubt about how accurate the non-farm payroll report is, or at least not necessarily accuracy alone, but how relevant it is. When you have a report that's counting things like people have multiple jobs as multiple job holders, that doesn't really seem accurate. But then again, the employment percentages or the amount of unemployment we have in this country doesn't take into effect the participation rate. So if you're somebody who's decided to no longer even try to find a job, you're considered no longer part of the labor force participation, and they don't count you as unemployed, even if you potentially are, even if you are receiving transfer benefits and making jobless claims and getting unemployment benefits. So this is a lot of screwy data. People have gotten a little wiser, particularly because of podcasts like mine, about how this information works, and they don't trust it as much. So I don't know why they keep sticking to it, but the market still responds to it the same way as they have done today, Friday. So non-farm payroll came out, more jobs were added, a little over 200,000. That's a pretty decent number. If you can keep adding that many, it's, the economy is going to keep growing. Things are going to stay healthy. Unfortunately, the wage growth numbers, or fortunately, depending on how you want to look at this, were not as strong as had hoped. And that's not a good thing for employment. Well, it's certainly not a good thing for people who are out there hoping to see their wages improve, as inflation is still really, really high year over year. And keep in mind, inflation is a metric that is based on a rate of change. So when you're using a comparable or the base effects of last year to this year, you're going to have really high inflation. So coming into 2023, it wouldn't be shocking to see inflation relatively muted. It doesn't mean that all of a sudden things are better. It just means year over year there hasn't been a lot of change. Prices don't necessarily go down. So if wage growth isn't accelerating at a pace fast enough or significant enough to catch up with the inflation that we've had the past year, which at one point peaked at 9% year over year. That was, I believe, the June or July CPI annual figure. Then people are going to be nervous about the outlook for the economy. Is the consumer going to be healthy enough to continually spending in the marketplace, keeping the economy rolling? Which brings us to the second data set, which came out this morning, not much long after NFP, after the non-farm payroll report. And that was the ISM, the Institute for Supply Management, puts out an index for both manufacturing information and the services sectors. And so the report that came out today from the ISM was for the services sector index. And outside of the U.S. economy being on the precipice of a financial crisis, there has never been a report that missed expectations this much. So take from that what you will, but it does seem to indicate that we're probably on the verge of something dramatic. Maybe we don't want to bundle that into economic crisis just yet. Maybe it's just your standard recession. It feels like we've kind of been dragging in and out of recession all last year. I mean, for the first 2 quarters of last year, we had negative real growth, and that technically is considered a recession. But the administration didn't want to use that term and kind of added some additional caveats to what would make a recession. One of those things was the employment, the health of the labor market, the employment numbers. So fine, last year wasn't a recession, even though we had a negative growth 2 quarters. But when you start to have the services sector, like I said just a minute ago, we had the employment numbers were strong, but wages were not. And when you have the services sector start to roll over or miss expectations like we just had today, that is cause for concern. Now, it's a cause to celebrate in the bond market, which is a cause to celebrate for mortgage rates. And the reason is because one of the factors of inflation that was making the Fed concerned, or generally everyone that was looking at this data concerned, that inflation could start to become anchored. And by anchored, meaning it gets so baked into the system that prices continually just spiral higher. And then you have this wage growth spiral where wages start to try to keep up with that, and then things get out of hand, and the Fed potentially loses control of price stability, and bad things happen. So we have the services sector that was looking continually really hot, as the term they like to use. Services sector numbers, services data, people were out there spending, going to restaurants, and that was showing up in the data, and that was spooking the markets because it looked like inflation wasn't going to subside. Now, this ISM Services Sector report was a huge miss, and it came, the new orders component came in under 50, and that is a level indicative of recession. So not only does the services sector look like it's cooling and cooling quickly, but we also saw wage growth slightly subdued in the employment report. And so overall, bonds were very happy about this, double whammy or double high five for the bond market. And we had a big rally in bonds today. So the 10-year Treasury bond is again flirting with 3.5%. And why that's important is because for most of last year, that was kind of the line in the sand. And at one point I had, said it felt like 3.5% was it. We had hit the high and it was going to be lower yields from there, which seemed true for a little bit. We had the 10-year go all the way back down to 2.75 at one point before 2.75 put in a lot of resistance and yields shot way back up. We had really ugly months in October and November. Again, inflation was a big motivator behind that, and I'll talk about that in a second. But the 10-year broke out and went as high as 4.25, level we had not seen since 2007. It looked like things were going to just completely blow out, and who knows how high yields were going to go. But we've calmed down. It looks like potentially those June, July CPI numbers are the peak of inflation. It potentially looks like those October, November numbers in the bond market are peak yields at 4.25. The 10-year is now back down to 3.5%. And this idea of 3.5 now acting as resistance between that 3.5 and 4.25 level. And, when does it become support again? Support meaning like yields don't want to break over that technical level and stay under 3.5%. Well, hopefully pretty soon. I mean, like I said, first week of 2023, we're already starting out on the right foot. If you're a fan of high bond prices, low interest rates, like we are here at the Mortgage Guru podcast. So we'll see if this continues to go our way. And so in addition to the U.S. government bonds improving, mortgage rates also improved off the back of that positive or bond-friendly data. And we're getting ever so closer to the 5% level on 30-year fixed mortgage rates. So today, after today's rally, we saw 30-year fixed rates come back down into that low 6% range, which is good news. So all of this is a little bit of tailwind. We need a little bit of momentum. 2020 was a lot to digest for everybody. There's so many things going on, and inflation was really the big headline throughout the year. Yes, I understand the Fed was raising rates, and everybody wants to put a bunch of emphasis on that. But this is a good time, a good opportunity for us to highlight the relationship that mortgage rates have to bonds and how inflation data is significantly more impactful to mortgage rates than Fed policy decisions. And I don't mean to, beat a dead horse over this topic, but it is so important because 2022 shows you how narratives can just get out of control. And if you're not familiar with another show that I do, another podcast I do with my friend Brent Johnson, check that out. It's called Milkshakes Markets Madness. The milkshakes component's kind of a fun way that Brent uses movies and the analogy of the milkshake concept from There Will Be Blood, I Drink Your Milkshake, to describe the financial system. So we kind of coined that, which is an infamous thing that he's come up with. We use that in the name for the podcast. We talk about all kinds of things, financial markets. But the reason I'm mentioning that is we talk about narratives and the power of narratives and how investors, especially hedge fund managers, when it comes to trying to articulate their investment themes, the importance or the impact of a good story. Well, I don't think there's a better narrative that has influenced the way people think than the idea that the Fed is this Wizard of Oz behind the curtain, manipulating the markets ever so gingerly, with these magic little knobs. Well, when it comes to real estate and mortgage interest rates, it's a false narrative, in my opinion, because it's more like the tail wagging the dog. I feel like the market and the market response to certain data points drives the Fed's hands. And so when it comes to mortgage rates, the thing that really drove interest rates from where they were just a year prior, record lows, 30-year fixed rates in the 2% range, to where they peaked out at in 2022 as high as 7% at one point. The reason that happened is inflation, which is why this week is so critical to starting us out on the right foot going into a new year and potentially a downtrend in mortgage rates, because the inflation data was so red hot, and bond investors do not want to own bonds when inflation is out of control. They don't like inflation in any circumstance, but especially not 40-year high inflation, because if you're invested in a bond and you have 7%, 9% inflation, the principal value of that bond is eroding faster than the yield that you're getting or the cash flow that you're getting from that can offset it. So you're losing money. So they want to dump those bonds quickly. The more people that are selling those bonds, the price of those bonds fall and interest rates go up. And that's what we saw happen rapidly and significantly last year. Investors couldn't throw bonds out the window fast enough, and interest rates skyrocketed from where they were the year prior to, like I said, the 7% range. We've come up back from that cliff, and it looks like we might be slowly climbing down the hill now, because in the inflation data looks like it has peaked and is rolling over. When we look at month to month, the trend is declining. And that is super important because, like I said, this rate of change perspective that the CPI, the Consumer Price Index, gives us the inflation metric by, this rate of change year over year, can be deceiving when you're going from a very low point to a very high point in a short period of time, which we did from 2021 to 2022. Not a lot of inflation to 40-year high inflation. There's a lot of shock factor in those numbers. Now, going from a 40-year high inflation to maybe flat or even slightly down in 2023, the impact of that on a year-over-year basis is going to probably give the wrong impression the other direction. Like suddenly we've slayed the inflation dragon. Maybe we have, but what's more important right now, what the Fed looks at especially, is the month to month. Now, speaking of the Fed, they have been articulating very clearly that they have no plans of taking their foot off the gas when it comes to rate hikes. But realistically, they got to be careful that they don't crash the car. And if they do, it's just a slight fender bender. And so maybe we get another rate hike or two, but I don't think the Fed is going to be hyper aggressive on rate hikes over the next 2 quarters if the data keeps coming in like it is, which is service sector cooling, wage growth slowing, month to month, in core inflation declining, and year over year relatively stable. So the bond market's sniffing this out, as they always do. They sniffed out inflation being a problem early and started selling off, and mortgage rates peaked long before the Fed, I shouldn't say peaked, but started to elevate quickly long before the Fed did one rate hike. So the Fed raising their overnight lending rate does not significantly impact mortgage rates. I had to pause there to choose my words wisely, because of course Fed policy is going to have this broader impact on all markets. It's their policies do have an impact on the cost of money, especially between banks, who are the ones that are doing the interbank lending and the overnight lending with the Fed and other banks of similar size. That's what the Fed is impacting there. And that trickles down, especially short-term lending rates, on things like credit cards. And credit cards have skyrocketed, which is probably one of the reasons why the services sector is slowing or coming under pressure, because the consumer can no longer lever up their purchases. Their credit cards are probably maxed out. And if not, the amount of disposable income that they have to pay those bills is maxed out because the interest rates on those are so high. The other thing that's impacted by the Fed and overnight lending rate are second mortgage loans, specifically HELOCs, home equity lines of credit. And these are something that loan originators were getting really excited about as a cash out alternative in the short term for borrowers last year, because everyone had record low 30-year fixed rates, but they had debt that they want to consolidate as they normally do, but they couldn't go through the typical 30-year cash out refinance because they had this great rate, and mortgage rates all of last year were pretty ugly. So they started looking at doing a second lien position mortgage, and you could do fixed rate versions of that. But HELOCs, for a little window of time, had some competitive options. You could get a decent rate, but those HELOCs tend to be adjustable. They're adjustable rate mortgages. So anyone who did a HELOC at the time, first quarter, maybe second quarter of last year, to kind of get some of their debts in order, are already feeling the pinch on that, because the rates on those loans are adjusting along with these Fed rate hikes. So you're now seeing these HELOC rates that maybe started out last year looking pretty good in the 3-4% range, now in the 7-8-9% range. So it doesn't make a lot of sense. And I think what you're going to start to see later this year is that trend continues. Short-term lending rates remain elevated because the Fed's going to keep hiking and or keep the overnight lending rate high, which means in order for banks to make money on their short-term loans or adjustable rate mortgages, they're going to have to pass those higher rates on to the consumer. So HELOC rates are going to continue to go up and or remain high, while fixed rate mortgages, which when they meet conforming guidelines, are mostly influenced by mortgage bonds and mortgage bond yields. So I think as inflation stays flat and all the things that I've talked about in this episode, consumer sector continues to cool, all of these things start to point more towards a slowing economy, potentially recession. Investors are going to start buying bonds again. That's going to push the price of bonds up and interest rates down, which means 30-year fixed conforming mortgages are going to slowly start to slide lower. And if we start getting into, mid fives, even potentially high 4% 30-year fixed mortgages, goodbye HELOCs. They no longer make any sense. And investors are going to be consolidating their debts together back into a fixed rate mortgage, paying off those seconds. And if they haven't done a second or HELOC yet, well, they're going to be taking their credit card debts and paying those things off, which adds a boost to the entire economy. So maybe the recession isn't super deep. Maybe we don't have some, as I said before, the Fed driving the car into a wall. Maybe it's a slight fender bender because some of this knock-on effects or the bounce back in the bond market maybe gives borrowers some breathing room in terms of their disposable income. We'll see. I can't predict the future. I may be a mortgage guru, as I claim, but I don't have my crystal ball sometimes. I got to plug that back in. But right now, I'm optimistic about what 2023 is going to bring for mortgage rates. This was a great start to the year, a great first week, not necessarily for the overall economic data, but unfortunately, for the mortgage world, when it comes to low interest rates, usually the lowest rates, the best opportunities we see for low rates and doing refinances, etc., is when the economy is going through a few speed bumps or worse, a recession, financial crisis. So this is something that we'll keep highlighting and I'll talk about on the next episode, because although we're not quite there yet, the interest rates on fixed rate mortgages aren't something to jump up and cheer about just yet. Keep in mind that the housing market is slowing in terms of property values and home prices and home sales. Mortgage rates at 7% and the Fed doing all the rate hikes that they did, that takes a while to work itself through the economy. And we're just starting to see that now. We've had 4 consecutive months decline in home prices. So be careful, the tightrope that you're walking here. If you have debts to consolidate or potentially you think that down the road you will, now, although interest rates aren't super attractive, it may be the time to look at doing some sort of blended rate option where, although your 30-year fixed rate is great, maybe you look at a second rate with a fixed mortgage. Perhaps it's a little better or comparable to what the HELOC is right now, but that HELOC is going to keep adjusting when that fixed second won't. And then that gives you some breathing room temporarily while you have the equity. Or potentially, depending on what your first mortgage is right now, you just do a single loan consolidation, pay off all that debt. But again, payment's going to dictate that. Doing a little bit of hey, what's going to happen in the future is important in addition to what rates and payments are today, because if values continue to drop, you might not have the equity that you need to consolidate the debt and still qualify. So don't get caught with your back in the corner because you're being picky about a 0.5% or a full percent interest rate and compared to what you have now or what a debt consolidation might look like. Be open-minded, be objective about this. Don't just look at where interest rates are today, but have a sense of potentially where they could be tomorrow. In the case of what I'm mentioning right now, have that same type of mentality about home values. Home prices don't always go up. Over time, I understand they're a good hedge against inflation. Their mean or the average trends up. I get all that. The data, we can see that. But we are kind of coming back to that average. We blew out of that in 2020, 2021 because the Fed had suppressed interest rates to artificial lows. Well, we're coming back to earth. And depending on, when you bought or how much debt you need to consolidate, you might not have as much equity in your home to do that 6 months from now. So keep that in mind. Thanks for joining me. This is the first episode of the Mortgage Guru podcast for 2023. I'm excited for you to follow along each week with me this year in 2023. It's a great first week. We had some positive news for mortgage rates, and hopefully that continues. I look forward to seeing you next week. Have a great weekend.